Thomson Reuters Risk and Fraud Solutions empower financial institutions to safely onboard and continuously evaluate customers, members, and vendors, and increase new business securely through automated technology. Visit tr.com/clear to learn more. Hi, and welcome to episode 3 of FinCrime Unfiltered. I'm Sarah Beth Felix. As you can probably tell, my background looks a little bit different than the last two, and that's because I'm on the road. I'm in beautiful Dublin, Ireland, and I love it here. I feel like it's kind of like my second home. But I'm here speaking at the European Anti-Financial Crime Summit, hosted by AML Intelligence, my good friends there. And while later on today I get to address a group of high-level government officials from the EU, new AML group, as well as some Irish government officials and other representatives from across Europe. Those comments will be Chatham House rules. But today, like I said at the end of episode 2, I really wanted to start unraveling the onion of unregulated payment ecosystems. That's the general term that I use. And while I do talk about this quite a bit, I'm very vocal, very opinionated per usual on LinkedIn. And I try to highlight when I see large cases that the Department of Justice and other law enforcement agencies have brought forth. I wanted to at least start the conversation because I feel like even though I've been posting about it for well over a decade, my first presentation was actually dated, I believe, 2015, my first formal presentation about unregulated payment ecosystems, but I've been writing about this since 2013. So while the term payment ecosystems may not clearly define everything for everyone, that's really over the years what I've had to kind of come up with because the term fintech is new. When we look at payment processors, right, that have been around since the first debit cards and credit cards were issued in the 80s, we still have payment processors. Now, some of those payment processors, some of those legacy ones now consider themselves fintech. Some of them have actually gotten into the fintech space as well. But when I say payment ecosystems, I mean any non-traditional way in which money can be moved or stored or concealed, really, even if there is an intention in the concealment. So for the fintech term, I think we kind of use those interchangeably, but not all fintechs are payment processors and not all payment processors are fintechs. There are some fintechs, and I posted about this last year. I posted a Venn diagram because I feel like we need some clear definitions from U.S. federal government about what is a fintech, because we have a lot of regtech companies that like to consider themselves fintech, so they get some arbitrary award for best fintech. And I'm like, wait, you're a regtech, you're not a fintech. So I do believe that there are clear roles that fintechs play versus regtechs. Regtechs for me are those solutions that don't actually sit in between a person or a business and a traditional financial institution in terms of movement of funds or value. Regtechs for me would be like the AML and sanction systems of the world. So just to get that out of the way. Okay, I know definitions aren't exactly the best thing to start off an episode with, but I think it is important because when we start talking about the payment ecosystem as a whole in the US, it's something really that the FATF hasn't even really gotten into. When we look at our mutual evaluations, while we do have several scores that are not compliant or partially compliant from the FATF, they really haven't asked that second or third question when they're doing their mutual evaluation of recommendation 15, and then the one on the money on MVTS. So we have new technology, new products, and then we have the MVTS recommendation. And when you read our mutual evaluations performed on the US, the FATF very clearly states that we do have MSB regulations, therefore they give us a compliant rating when it comes to money value transfer services. That's MVTS. One of the things that they don't ask is how much money moves through the US, moves through non-traditional financial institutions, other payment companies that are not under MSB laws. So while our MSB laws certainly have a lot of work to be done, I feel like that's a whole other episode. But just basically, MSB laws have been around since the 80s. We have money remitters. Several years ago, FinCEN kind of shoved into MSB definitions crypto under money remitters. While I feel like that was good for a temporary time, I fully expected there to be some updates in the last 10 or 11 years. We haven't seen them. But I feel like MSB laws are for traditional straight line money remitters, currency, fiat currency exchanges, and other, check cashers and things like that. I feel like we need new laws that are specifically tailored to new value ecosystems like crypto. I don't think they belong under the MSB laws from 40 plus years ago. Again, that's uh, a separate episode. But I wanted to talk about payment ecosystems just generally. And when I say unregulated, before you come after me, when I say unregulated, I mean not regulated from an anti-money laundering perspective. So these are not, I'm not talking about what the CFPB did or does, or maybe did now, but I'm talking about not from a fraud perspective. I'm talking about purely the definition of money remitters under MSB laws. And there are clear loopholes that our federal law allows. The first one, I think the biggest one, being 31 CFR 1010 .100 FF5 I think is somewhere around there. I'm trying to go from memory. But that, if you were to go read that, they define what money remitters are, and then they say, oh, but you're not a money remitter if you do XYZ. And on top of that, we have a whole host, 80 plus administrative rulings available on FinCEN's site. Now, I did notice that they took down the direct link to administrative rulings. I don't know why, but you have to know the whole URL in order to get to the host, to the 80 plus, I think 82 or 83 administrative rulings that are available on the FinCEN site. But throughout those administrative rulings, these are basically legal opinions issued by FinCEN to firms saying, hey, this is what my firm does. Can you tell us whether or not this regulation or that regulation would apply? And there are, throughout those rulings, there are some that say, yes, from what you've specifically described, you do fit the definition of money remitter or an MSB generally. Then there are some where it's like, no, you don't fit because you meet all of these loopholes that are allowed for in that CFR 1010-100. So one of the things is that's never been evaluated in the FATF. And I've talked to several people at FATF over the years at these conferences I go to, and I'm like, please, not that I want the US to be to get in trouble, but this is a huge gap. The US is number one in the world for fintech startups, and not for good reason. It's not because of anything like we're super technologically advanced. Well, I shouldn't impose my opinion on why companies come here, but I have received enough phone calls from non-US fintechs looking to move into this space. And when they call and they say, hey, so this is our general approach to AML, this is how we're going to do it, this is how our host country requires us to do it. And my response is, well, technically, while I'm not a lawyer, you don't qualify for the definition of an MSB because your product does XYZ. And here's all the administrative rulings that you can get your legal opinion on. And then sure enough, they all come back and they say, yeah, our big national, our global law firm also agrees with you. So it's not that I'm trying to help companies find those loopholes, but it's one of those things that over the years, it's been very difficult to say, oh, well, why the US doesn't technically require this, you should do it anyways. It's a massive overhead. And I have been very opinionated about why larger US-based fintechs have such wonderful shareholder value. And I think it's because a lot of them, they have divided out their areas that do fall under regulatory requirements from an AML or an MSB perspective versus those huge chunks of their business that don't. And while there's nothing ethically wrong or legally wrong with that, I feel like if the US were to actually clearly define this is a fintech, this is an MSB, this is a CVC, a crypto company, and these are the regulations for each one of them, it would probably upset some shareholders because the value, that profit margin would definitely go down, because they would require these behemoth fintechs that have, strict AML requirements over one part of their business to apply that across all their businesses that they have. So, and I'm not trying to call any company out. Again, I have no issue with these companies. They are strategic. They are out to provide shareholder value. But from my position in the financial crime world, I can't imagine the amount of illicit activity that goes on for years and years and years and years and years without any AML eyeballs looking at them. And when I tried to quantify this about 12 years ago, it was several $100 billion that I could roughly estimate that was in this space. And this is pre-fintech term. So this is when we just had payment companies. And now I will say it's in the trillions with a T. I know one company particularly is well over, they're singly well over $1 trillion. And then there's several other that are very close to $1 trillion. Now, does that mean all of that money has no AML eyeballs at that one particular company? No, of course not, because they've divided out how they approach AML compliance to what the law requires of them. So again, not putting any company on blast, but I think at least this is something everyone has to talk about, even if you are just a traditional banker, because all of these payment ecosystem companies, from fintechs to payment processors to earned wage access companies to the rainbow flavor of fintechs that we have, they all bank with a bank. They do not have direct connections to the Federal Reserve to clear payments. So they all have to have a bank partner, and most of them have multiple bank partners. So that means if you're in the fintech space, if you're in the payment space, if you're in the traditional FI space, this has an impact on you, because especially if you're a bank, you have the transference of risk. That's what I call it. And while you are not the de facto regulator, you are sometimes in facto the regulator, because your regulators really expect you as the hyper-regulated bank, credit union, to be kind of the throttle, if you will, to fintechs or payment companies that aren't doing what they're supposed to be doing, and they shove it under the CDD pillar, the customer due diligence pillar. We've seen it before in consent orders. We saw a host of them from mid-2023 all throughout 2024. We called it BAS, right? All these BAS-focused consent orders in which banks got written up for not managing their fintech's risk correctly. So again, in writing, in the FFIEC exam manual, it clearly states that you are not the de facto regulator of non-bank financial institutions. However, the actions of regulators say something completely different. FinCrime Unfiltered is proudly supported by Hummingbird. Hummingbird is a modern compliance platform designed to make financial crime investigations smarter, faster, and more effective. Because today's financial criminals are sophisticated, savvy, and agile, meaning the tools used to fight them should be too. Learn more at hummingbird.co. With that being said, that was kind of a long intro. I do want to talk about how we are seeing an uptick in some of the cases related to unregulated payment ecosystems. And my heart gets this little flutter almost every time I see this. Just because I feel like it's like another case in which we can point to it and say, see, if we had correct regulatory requirements of this company or this group of types of companies, we would have caught this sooner. And the most recent one that I could think of was about $128 million case, and it was worked by HSI and CI, and it was this case down in South Florida. This Finfluencer, I think they're called, financial influencer. And he basically lived the high life. The case is public. If you want to look it up, it's Liburdi, Liberty, I think is the main guy's name. But as you read through the case, it's very interesting because they talk around, but they don't actually dive into how the money moved. But when I read it from a perspective of this is transaction laundering. And they moved $128 million. And if you think about it from a pure, like if we were to peel out payment processors from payment ecosystems as a whole, payment processors, and I know I'm going to get a lot of hate for this because I already get a lot of hate on LinkedIn and I don't have nearly as many people reading my posts. And this is not to put payment processors on blast. And I will say, over the last year, just a year, I have seen an uptick in hiring of AML officers specifically for payment processors in the US. And I think it's because this is finally getting enough buzz, and their payment clearing partners, right? Their banks are telling them, while you're not regulated, the bank that's clearing your funds, I am hyper regulated, which means that you need to look more like me. And I have seen this because I do have bank clients that are in the acquiring space and in the sponsor bank space. And I do have payment processing clients. And I'm hearing from both sides that they are getting pressure to start looking more like a regulated entity, even though federal law doesn't require it. So I think that is a good position to take. It does alleviate a little bit of the risk that's transferred to the bank partner, but it doesn't get rid of all of it, because at the end of the day, that bank still has to act like bank partner and regulator, which is, to me, very unfair. Now, if you're watching this and you're going, wait, what about all the other unregulated industries? I do have another episode later where I am going to be talking about not just the unregulated payment ecosystem, but also all of the other unregulated industries that we have in the US, some of which are known because it's in the FATF report and some of which are not. So, but I wanted to talk about payments because it's trillions with a T, dollars worth of value that we see passing through these companies that do not have any federal AML requirements. And also I wanted to give one other exclusion. States, there are state requirements depending on the state that you're in. There's a handful, literally a handful of states that do regulate a little bit better from a payments perspective, a payment processor perspective, or even a crypto perspective. New York obviously coming to mind. But the majority of them, with New York being the outlier, they all default to what federal law requires. So if federal law doesn't require that payment processor or that payment company to have an AML system or to have an AML program because they don't fit the definition of an MSB because of that CFR, then the state's not going to require it. So I also wanted to get that out of the way because I do get a lot of LinkedIn messages about that. Well, what about states? Yes, and there are some states, but also CSBS, which is a kind of a conference, I think they call it, a conference of state banking supervisors. Even they don't look at this from an AML perspective because federal law doesn't require it. So now I will also put a little asterisk. There's a lot of asterisks in this episode, and that's because this is a very complex issue. There have been instances where CSBS does evaluate for AML requirements, but there's really no enforcement that they can impose because, again, federal law doesn't require it. Okay, so going back to the payment processor, if payment processors were to actually look like a traditional financial institution in terms of, or even an MSB, in terms of how they approach their customers, they would really have to monitor for transaction laundering. I mean, there are other things, other AML-related risks that occur in payment processors, but the majority of what I see missed on the regular, and the majority of what I see really happening in the majority of these cases, like the $128 million case I talked about, there was also a $30 million case, I believe, last week in South Carolina. The underpinning of that is a merchant that either is selling nothing, right? They're selling services or goods, but there's really no goods or services tied to them. And remember, if you're dealing with a merchant and that merchant is selling sex or drugs, you're not really going to get any chargebacks. And that's the majority of what payment processors are looking for. They are monitoring for chargebacks. I have seen some of the world's largest payment processors and their approach to monitoring. And it is all about chargebacks. It's about velocity. It doesn't look from a contextual perspective at whether or not that dollar amount is reasonable given the location of the customer, given the products and services of the customer, and then monitoring that on an ongoing basis. So if nobody's looking at it from that perspective and it falls on the banks then, right, because these merchants also have to have a bank relationship in order to receive those funds from that payment processor for their revenue. So then it falls on banks. So then banks then are constantly having to figure out, okay, how much revenue is normal for my customer? And while they should be doing that in a customer due diligence perspective, it's very difficult. I mean, when you look at a standard community bank that's 5 billion in assets and they have, tens of thousands of business customers, to go out and try to figure out, oh, is it reasonable that they're getting an ACH deposit from this payment processor, for their goods and services, when we really should be imposing that, not to alleviate it from the bank, but we should be imposing that perspective on that payment processor. But instead, what that payment processor does is that they really look at it from the perspective of, will I lose my shorts on this, right? Like I don't want this merchant to have such bad products or so low in their card in their card swipes, right, in their revenue, that it's not going to be profitable for me. Therefore, payment processors really are looking at it from a fraud perspective. That's kind of how I put it under there. And as we know, fraud and money laundering are completely different things. The way in which you detect them. Now, is there some fraud that turns into money laundering? Of course. Is there some fraud that's SAR reportable and more under that money laundering type of process? Yes. But the way in which you detect fraud and the way you detect money laundering should be two different approaches. And it's certainly two different mindsets of the analyst. So I definitely believe that when it comes to detecting money laundering, you need a lot of creativity. And you definitely have to think like a criminal, which I say a lot. But what we've seen is a lot of payment processors are just kind of renaming their fraud department financial crime. There's kind of lumping it into this financial crime. And it gives, I think, an air of, oh yeah, I'm definitely doing the money laundering review to their bank partners. And I've seen this with some large payment processors where they've renamed things as financial crime. They actually have someone that says an AML officer, but there's really no staff. And so for me, the proof, the proof is in the pudding, in the staffing pudding specifically. So if a payment processor changes things to financial crime, they put an AML officer or financial crime, global financial crimes officer or something like that, that gives that feeling of having a money laundering focus, but there's really no staff for money laundering specifically. There's no increase in that staff. There's no rules that are really going after the transaction monitoring side. From a money laundering perspective, then that risk is still very much present and still being transferred to their bank partner, like we saw in the $128 million Liberty case that I talked about earlier. They actually named two different banks that were involved in that, and they did not name them as the banks did something bad. This case was solely about this group of influencers that were basically transaction laundering. They had merchant accounts. Of course, these merchants sold nothing. And obviously these merchants, these companies were set up in our onshore offshore states, which I've talked about in several other episodes, because I feel like we always have to talk about that until it changes. All right. So beyond payment processors, payment ecosystem, when I start to kind of loop in fintechs into this, I don't want you to think that I'm anti-innovation. I am pro innovation. I like things that fix problems for others. I'm not somebody who wants an overabundance of regulation, but I do believe, at least leading up to this current administration, we had a little bit of momentum, if you will. We had several draft laws that were written, kind of trying to close the gap of payment processors and fintechs and things like that. And now with this current administration, they've made it very clear that for every, I think, one new regulation, they want to roll back 10. So I don't see anything changing, at least for the next 3.5 years. But that doesn't mean the risk goes away, and it doesn't mean that the next regulatory exam that you get under the next administration won't hold you accountable, if you're a bank, for dirty money that went through your institution. So we want, basically, the bottom line on that was we want responsible innovation. So we have, this regulatory exemption that's been occurring for years on the payment processor side. And because a lot of lawyers I work with are brilliant and they use the law correctly, they are able to see now kind of a boom in fintech that goes outside of a traditional payment processor, but still meets those definitions of an ACH rail. There's a bank on both sides. Is there good in services, things like that, that make up those loopholes. And while a fintech may not be considered a traditional payment processor, they're still able to use those existing loopholes. And one of those examples we can talk about is from an online merchant. And I don't mean selling goods. I mean from house rentals to event planning and invitations where people can go on and buy tickets to your private event. There's a whole host of them. There's a crowdfunding, which I've written about for years. All of these things still take full advantage and use of those legal loopholes. And that's kind of the big boom that we see in fintech, where they come in and they go, oh, well, I'm not a traditional payment processor, but I'm basically doing the same thing, and I meet all four of those loopholes that CFR allows. And so then, we see things like, you can rent a house, you can rent a room in a house, and there's really the payout rail to the owner of that house, or the payout rail to the host of the event, or the payout rail to the private seller on a large online marketplace. Those are not regulated because it meets those four, three to four loopholes that they have under the CFR. So again, it's not illegal. It's very strategic, and it's taking advantage of the way in which the U.S. allows for innovation, really at the expense of compliance. So I do have a problem with that. So if you're a bank, what does that mean to you? Well, if you are a sponsor bank, if you are a partner bank, an acquiring bank of a fintech or a traditional payment processor, it means that it's really on you to make sure that you're monitoring those merchants, especially higher risk merchants. I think that always is the case, but I will say, don't lose sight of those merchants that are not high risk. So you have a shoe store, right? You have a brick and mortar shoe store, or you have an online shoe store. The reasonableness level that I've talked about for a long time really pays off when it comes to monitoring unregulated payment processors and other fintechs. Is it reasonable that this merchant selling X product or X service would make this much money, would have this much in revenue, which goes through the payment processor? Is that normal? And I think that's very hard to program. It's very hard to program because there are some outliers, right? And it's very hard to say, if you are in a city that has, X amount of citizens in it, the population is X, and you're this type of industry code, you should not be getting more than X amount of dollars in revenue. That's very, very difficult, if not impossible, to programmatically detect. So then what we see is peer monitoring. And I don't necessarily agree with peer monitoring. I think in some aspects, depending on the industry, depending on the a location of it, there could be some interesting analytics that occur when you're looking at peers. But I think to say, oh, well, we can't programmatically or efficiently detect transaction laundering because it needs a human to apply what's reasonable, So therefore, we're going to switch that out and just make it a peer-to-peer monitoring. So therefore, as long as this company stays in line with their peers, then it must mean they're legitimate. And I have a problem with that logic. So while my solutions to unregulated payment ecosystem companies aren't necessarily the most efficient, I do believe with the rise of AI and the way in which we can have experts train the model, which I did touch on last episode, I do believe that we need a better approach to detecting money laundering in payment processors that are traditional, fintechs, but also in their bank partners, because at the end of the day, it's still the bank partners on the hook for whether or not their downstream fintechs and their payment processors are really doing what they're supposed to be doing. So just to kind of close this out, because I think we're about close to time, I do have a list, and I think it is important for financial institutions, for traditional financial institutions, to at least do a temperature check of the business customers that they're banking. And while you are not the de facto regulator of any payment processor that is depositing funds into your business customers' accounts, I think it is important until our federal regulatory framework really gets up to date with everything, that in a traditional financial institution that you start looking for those keywords in the ACH description that talk about or that give you notice that this is a payment processing deposit. I do have a list. I've kept a list for years, and I add to it every time I go into a bank and I see, oh, there's a new payment processor. There's a jabillion of them, and they pop up all the time. And I think it is important to start looking at that and kind of cross-referencing that with some of the industry code descriptions. And as you go through them, and I think it's a good training exercise for your team as well, where they start looking at, wow, that's a lot of revenue per month coming from what we now know to be a payment processor. And this is revenue to this business, but their industry code says it's, like I said earlier, a shoe, like a brick and mortar shoe store. What are they selling where their overall revenue per month is 100 to 150,000? I think that type of approach where you start to go, what else are they selling, right? They're selling shoes, but also what else? And of course, remember, if they're selling shoes and something else like drugs, they won't get charged back. So that payment processor won't be looking at that from that perspective. That payment processor won't be going, oh, is this reasonable that these shoes are, totaling this much in this middle of nowhere, Midwest town with a brick and mortar shoe store. So I think it is important to kind of look at it from that angle. Also, if you are a sponsor bank or an acquiring bank or a partner bank of any kind for traditional payment processors down to fintechs of any kind, just because your master services agreement says that downstream non-bank that you're dealing with will comply with federal laws, I have yet to see a master services agreement that actually doesn't have the word applicable in it. Every single one I've seen says that downstream partner will comply with applicable federal laws. And that is their get out of jail free card, okay? Which is why we don't see payment processors going under massive consent orders. One, because most of them aren't regulated from an AML perspective, but two, because it goes to the bank. Like we saw all the consent orders over the last 18 plus months, well, I guess two years now, for these partner banks. So don't get thrown off because the legalese in this says that they will comply. You are missing the word applicable. And when there's no applicable federal law requiring them to be an MSB, then it really falls on you. Again, you are not the de facto, but you are in facto the regulator, at least in practice, until we get this done. I think for government officials, it's very important that we start to look at peer nations, maybe start with the J5 and look at our sister, our peer nations and how they're managing it. Like, there's something wrong when a payment processor or a fintech is in Australia, in the UK, and they're fully regulated from an AML perspective. They have a different type of license that they have to have, and also a whole bunch of different types of AML regulations. And they come to the US and they basically don't have any of that. That's not a good look. So, but I think the way that Australia specifically defines what payment companies do and how they function. And then they say, well, if your product does XYZ, or if your customer looks like this, then this set of regulations applies. I think that way that it's written is great. And I would encourage our federal lawmakers to get there. But I think without that, if we aren't wanting to take cues from our sister nations, I think it is important that we start to write regulations with practitioners in mind, that you have bankers, not just lawyers, that you have bankers in the room, you have fintech experts that are doing this right in banks, that are managing traditional payment processors, as well as new fintechs in a correct manner. And you have those AML officers in the room, or at least providing draft language, because when we write regulations that basically all shoves all the risk to banks, from a federal perspective, it's not fair, it's not sustainable. And we also saw that over the last several years of consent orders. So I would encourage any federal lawmaker to look at some of the gaps that we have that allow trillions of dollars to flow through the U.S. without any type of AML eyeball, to look at how we shore up those loopholes. I know it will take an act of Congress, basically. I mean, that is what it's going to take. But up until our regulatory environment catches up with technology, which I think will take a little bit, it really is up to banks to start, I think, shoving downward, right? Because everything kind of gets lumped on them. So I think it's up to banks to start, pushing their infrastructure down to those unregulated parties. Now, I did not talk about private ATM owners today and how private ATM networks are unregulated from an AML perspective. I do want to get into that because I think it's hilarious, not in a ha-ha way, but like in a what the heck are we thinking kind of way, that somebody can go on Amazon and buy a private ATM and have it delivered to their house via Prime, and then they can go to an unregulated ATM network and show them a clean bill of health. They've never had any criminal record, and I promise you this is my business, and there's really no due diligence done other than, running a thick background check on the person and the business to make sure they haven't violated any laws, and boom, you have a connection to the ACH network, and you can sell whatever you want out of your garage and use a private ATM to launder those funds. So I do want to get into that, but for the sake of time, I just wanted to kind of talk about general unregulated payment ecosystem in the US. If you have any questions, would love to hear from you. Please email me, leave comments below. I've gotten several emails from the last couple shows, and I will be answering those when I get a minute, I promise. But thank you for watching our third episode of FinCrime Unfiltered, and we'll catch you on the next one.